really when it comes to FHA conventional loans, 80% is the rule on
Sure.
that when it comes to the guidelines as far as what that cash out looks like. But on a VA loan, for instance, you can go all the way up to 100%.
Oh, no kidding.
Yeah. So.
All right. Well, Ben, we have a couple of questions today, so we'll jump into it. But first,
Good to go.
who are you and where do you work at?
I am Ben Tomtruck. I work at Exarban Mortgage. I am the lead mortgage advisor here at Exarban Mortgage. I'm here to serve you.
Perfect. Well, how long have you been at Exarban Mortgage?
2.5 years.
2.5 years.
2.5 years now.
I think I saw something on like your story this morning or last night or something. What was that?
So UWM, one of the lenders that we use, I was top 20 purchase LO in Nebraska last year. So hopefully,
let's go.
Hopefully jump into top 3 or 5 next year. We'll see.
Yes, sir. Is it a bigger trophy on the top 3 to 5 or?
I actually don't know. I probably need to ask.
Or you can just get up there and then get it and then you can tell.
Yeah, then I'll be able to find out.
It's one of the ways.
Yeah,
one of the
absolutely.
ways. Cool. Well, so we got that background for you. So we'll just jump in here to a couple of different questions. We can kind of see if you got a chance to look at those, and we can see which ones you wanted to go into first. I was really thinking
right on down the line if you want.
Go right down the line.
Yeah.
Perfect. Yeah.
As far as buying a home and not having anything out of pocket, I mean, you keep in mind you gotta at least have something in there to maybe pay for the appraisal. Get that earnest money deposited, with the title company, things like that, and you might get that money back later down the road, after closing. But as far as getting into a home with nothing out of pocket or as close to as possible, a few different options I'll run through. One, utilize a USDA loan.
Sure.
So if you're in a rural area, that is, that particular home is in a county that you can qualify for a USDA loan. You meet all the other requirements when it comes to credit, when it comes to income, things like that. It is 0% down. So come in with 0 down on the loan, and then you can ask for some seller concessions as well. So that's a way to get in and not be able to have really anything out of pocket on that end. Some other options, whether that's FHA, whether that's conventional loans, there are grants. There are down payment assistance programs as well, and sometimes it might not be able to cover everything.
Sure.
When it comes to that total cash to close, which is not only just your down payment, but that's another way to rope in seller concessions. And you do an amazing job of getting your clients and negotiating seller concessions.
Absolutely, it's easy in a market like this. But just to recap, the first question was, how do you buy a house for $0 out of pocket? Appreciate that. So the second one is buying a house with a cash out refinance from either a primary property or an investment property that's paid off. Which one would you rather go with and why?
Yep. The way I would go about it, and it would make a little bit more sense, for people who are a little bit more rate cautious on things. But on getting a cash out refi from a primary home, that's going to be a lot less of the interest rates are going to be a lot lower than taking a cash out refi from an investment property at the end of the day. I mean, you're looking, depending on the situation, sometimes 1%, 1.5% higher than where it would be on a primary home.
Sure. And for a cash out refinance, when you do that, what have you seen in terms of what's the normal for the cash out refinance? Like 80% is what I see a lot, 80-20. Is there any way you can go a little bit higher than that? Any way you can go a little lower, or what's
really when it comes to FHA conventional loans, 80% is the rule on that when it comes to the guidelines as far as what that cash out looks like. But on a VA loan, for instance, you can go all the way up to 100%.
Oh, no kidding.
Yeah. So, which is super nice. And we've had a lot of clients utilize that in the past.
With a VA loan, if you're going up to that 100% on the refinance, is it still roughly the same interest rate that they have as if they were getting the primary loan on it, or is it still a little bit higher?
Yeah, it's going to be a little bit higher.
Sure.
On that end. So if you do go up to 100%, it's going to be a lot higher than let's say if you go up to 90% loan to value on the home, for instance. So yeah, it is gonna be a little bit higher
That's
for sure.
crazy.
But
I didn't
it's
even know that.
yep, yep. So it's gonna be just a smidge higher.
Well, on the cash out refinance for a VA loan, does it have the same appraisal process as if you were buying the house?
Yeah, yeah, yeah. You still have to get an appraiser over there. They got to make sure that the market value
Sure.
is where you want to be at, where you want to be to make it make sense.
Perfect. Perfect. Well, I know we just got through this. We just went through one of these deals.
Mhm.
So let's dive in a little bit here on how we offset a DTI or your debt to income with a property that you already own to be able to purchase a new house.
Yep, absolutely. And this is something that we have helped our clients utilize in the past. Right, but when it comes to getting and offsetting that DTI,
Mm-hmm.
um, they want to see a lease agreement in place.
Sure.
Usually, they want to see a 12-month lease agreement in place. Sometimes they also want to see that that person who is leasing out your home has made that deposit as well.
The security deposit.
Yep, the security deposit on
Absolutely.
the house. And then what they're going to do, what underwriters are going to look at, depending on the program. So I'll go over a couple different options. So they're going to look as far as excluding that DTI. They are going to take 75% of that loan to value
Mm-hmm.
of the home, or sorry, whatever that lease is for. They're going to
The
take
lesser amount.
yeah, they're going to take 75%. Sorry, they're going to take 75%
Sure.
of that amount. So yeah, the lower of the two, whether that's the lease agreement or the market rents, you're gonna take 75% of that, and hopefully that covers enough of your mortgage to then exclude it. In this particular case that we worked on a little bit, it didn't exclude quite all of it, so they'll add a little bit back into that debt to income ratio for qualifications. But for the most part, depending on where your current payment is on your existing home,
Mm-hmm.
it'll exclude a good portion of it, if not all.
Absolutely. That's awesome.
Yep.
And then is it like a 12-month minimum lease that they have to have on there? Do you know that?
Yep. So it is a 12-month minimum lease on there, and some lenders might be a little bit more forgiving. You might not have to have a full 12-month on there. It might just be maybe 6 months, but it generally rule of thumb 12 months.
Sure. That's not bad at all.
Yeah.
I mean, you got 12 months, you got a tenant in there paying the mortgage for you for 12 months, and you qualify for a new house.
Exactly.
I mean, at that new point, I mean, I believe she's actually renting out the bedrooms in her new house as well. So she's pretty much house hacking the whole thing, which is fantastic. I think on her new house, it's like 270,000. Her mortgage payment was what, around 2,200.
Yeah, I think it was even less.
Yeah, less than
So
that. And
yeah.
then her roommates are paying a little bit more than half of that. So she's got another house that's being paid off by a tenant, and she's in this house only paying roughly a little, like a quarter or a third of the mortgage payment.
Mm-hmm.
So that's house hacking at its finest right
Oh
there.
yeah, absolutely. And if I would say to do that as many times over as you can. And when it comes to conventional loans, you can do that. You can buy a conventional home, live there in a year, let's say, get a 12-month lease out on it,
Sure.
exclude that debt, move into your next home for 5% down, and you can do that up to 4 different units, 10 different times.
Yeah, so you can get 10 different properties, up to 4 units per property.
Yep.
Correct.
Yep.
And then if you go and you buy one with the 5% down, you have to live in it?
Yep. Yeah, you
Okay.
got to live in one of the units.
Okay, and how long do you have to live in it?
Yep. I mean, you continue on that trend. I mean, I would say a year.
A year minimum. That's like basic rule of thumb. Staying there for a year. I gotcha. Okay. Okay. Well, let me ask you this. We got a couple of people who I actually talked to this week. They have some equity in their houses. They have a decent amount, and they're looking to buy more properties, but they don't know how to get the cash out besides the cash out refinance.
Mm-hmm.
So I wanted to see if we could touch on a HELOC.
Yeah.
Different avenues for the HELOC, kind of what it looks like payment wise, if there's anything interest deferred, anything like that you know of, and we'll just run with it from there.
Yeah, absolutely. So HELOCs, home equity line of credit, utilize the equity in your current home. It in everybody is a little bit different. Some lenders might go above 80% loan to value, so you can utilize that money in your home. But for the most part, a lot of them, and let's just say credit unions do an amazing job. They're with those HELOCs. The interest rates are always pretty good, pretty competitive
Sure.
on that end. But so let's just say, I'm just going to run you through an example of what you can maybe do with the HELOC and on that equity end of things. So let's just say, your house is worth 200,000. You owe $100,000 on it.
Mm-hmm.
They're going to take 80%. We're going to base it off of 80% loan to value. So that's
Sure.
160 on there. They're going to then be able to give you $60,000 back. So that 160 minus that $100,000 that you already owe on that house. They're going to be able to give that to you to then utilize for whether it's repairs, whether you want to buy an investment property, things like that. So it's your money to use. A lot of them will essentially that it'll be a little bit different
Sure.
as far as what that looks like as far as a prepayment or a payment back. But you're looking at first 10 years kind of like a drop period. So you can take from that account as you will.
Okay, so you don't have to spend all that 60,000.
Correct. Yeah.
Gotcha.
Most of the time you do not have to spend all of that 60,000. So you can kind of take as you please on that end, and then it'll usually be an interest only payment
Mm-hmm.
up until that 10-year mark, where then there's going to be a period of time where you're going to have to make principal and interest payments.
Gotcha.
And that can be, and you can then, just kind of depends. Every lender is going to be a little bit different as far as like how they work that.
Absolutely.
So,
That's great. And then if you have a HELOC for, say, the example you had for 60,000 is the HELOC amount, and you only take out 30,000,
mm-hmm.
are you paying on the full 60,000 if you didn't use the full thing, or are you paying on the 30 that you did use?
Only paying on the 30 that you use. The rest just is put in there at the end of the day. Yeah. So yeah,
Sure.
You're only paying on the 30. Usually, like I said, only interest, only payments on that end until that reaches kind of that payment, that prepayment or
Absolutely.
repayment period.
Now, with Exarban Mortgage here in Omaha, is it
Mhm.
something that you guys are able to offer a HELOC, or do you guys mostly do like cash out refinance and just refinances for the most part?
We usually really only, yeah, I would say cash out refinances is
Mm-hmm.
something when it comes like taking equity out of the house. That is something that we probably specialize a little bit more in versus, I mean, we can do HELOCs, but they're just not as they're just not as attractive than the whether it's Centrus or I don't know whatever
So
Metro or
yeah, so
whatever.
if you're like bread and butter in the mortgage industry is going to be actual home loans and then refinances,
Mm-hmm.
who would you recommend for say a HELOC, or who do you think would be able to be more of the competitive nature for a HELOC?
Yeah. So, I mean, for instance, I have my HELOC through Central Credit Union.
Mm-hmm.
But I would say some of the local credit unions around town are going to be your best bet as far as, and everybody's probably going to be a little bit different. You might have a prior relationship with them. You might be a long lasting client of theirs. So the terms might be a little bit different. But yeah, Centrus is somebody who I have used and it has actually gone pretty well.
Sure. So by working with a bank that you've banked at for years, you might be able to get a little bit more favorable rates.
Yeah, maybe so. It just kind of depends. Um, I have not experienced that in my past, but I have talked to clients who have, there's like, my bank's going to be able, or is able to help me out, and
Sure.
I don't really necessarily have any names, and banks that are, that they gave me, but
That's fine.
yeah, they were able to negotiate maybe a little bit more equity out of their house
Well,
and
I
things like
think
that.
that kind of takes us into another point here. When clients are getting pre-approved and going through that pre-approval process,
Mm-hmm.
check with multiple lenders just so that way that you can see if it's better rates going with your bank, or if someone like Ben over here at Exarban Mortgage can offer you guys something fairly competitive. But can you just touch base on that? I think it's a 14-day window. Is that what they get when they're pre-qualifying for like credit pulls and stuff like that to check with other lenders?
Yep. Usually it's about 30 days actually.
30 days. Okay.
Yeah. So 30 days. Yeah, and you never really see anybody just absolutely running through,
Mm-hmm.
just lenders on lenders when it comes to getting that all taken care of. I mean, everybody's going to be, it just kind of depends. Everybody's going to be somewhat, fairly competitive around the interest rates. Some might be better than others, but the interest rate. It's not all about the interest rate at the end of the day.
Sure.
Certain programs that other banks might have or might not have. Just kind of depends.
Yeah, just see what everybody has to offer and kind of fill out what's the best route for you moving forward.
Yeah.
I gotcha. Well, what was I going to ask you? I was going to ask you something about what was it? Man, it was just running through my mind. All right, let's do the next question. It'll come back to me. It'll come back to me. We had PMI. What the heck is it? How do I get rid of it?
Yeah. So private mortgage insurance. This is something on, you know, for instance, conventional loans.
Mm-hmm.
At the end of the day, if you're putting less than 20% down on that first purchase, or any purchase, you're going to have private mortgage insurance on that loan. You can request once you reach 20% equity in the home, you can request that mortgage insurance to come off.
So it doesn't just drop off.
Sometimes, yeah, it doesn't just drop off. But I've never actually heard of anybody requesting it and getting denied. I mean, you have
Gotcha.
20% equity in the home. Reach out to your mortgage servicer and see if they can get that removed. At 78% equity in the home,
Mm-hmm.
Loan to value, equity in that, it'll automatically fall off.
Perfect. Okay. Okay. Now let me ask you this, because I have a lot of people, first-time home buyers, that I use FHA loans for.
Mm.
So, what are the requirements with PMI, down payment wise, getting out of PMI on an FHA loan?
Yep. So on an FHA loan, and a lot of the times, if you're looking at a first-time home buyer, they're going to put the minimum 3.5% down.
Sure.
You are going to, if nothing changes in that loan, if you were just stay in that loan for 30 years, that PMI is going to be on there for the 30-year.
Okay, for the full loan?
Yeah, for the full 30 years.
So how would you get out of paying that for the full 30 years?
Yep. So a way to get out of paying that for the full 30 is you look at refinancing down the road, maybe into a conventional loan once you maybe reach that 20% equity mark.
Sure.
Or kind of where you think it might be, and then be able to get it off from there, or refinance back into an FHA loan. And then, depending on how much equity you do have in the home at that point in time, it might not be on there for the full 30 term, for
Gotcha.
30 years at that point.
So I heard something about if you put, say, like 10% down on an FHA loan, you could get out of it.
Yes. Yeah. There is then a timeline as far as how long that PMI is on there for, which is 10 years.
Okay, so if you put 3.5% down, you're going to be stuck with it for the full term until you refinance out of it to potentially a conventional loan.
Yep.
If you put 10% down, there's a term that comes with it before it falls off.
Yep.
Okay,
exactly.
Perfect.
Yeah. So it's not on there forever.
Sure.
And it's
great.
a little bit lower of mortgage insurance as well.
Okay, and then we wanted to go over how much is PMI based off of just, a regular 3.5% down, say a $200,000 house.
The PMI is really going to be, let's just, talk about conventional side of things. PMI is going to vary quite a bit.
Sure.
And it's going to vary on what that down payment looks like. It's going to vary on what your credit score looks like. And what that program looks like as well. So there's a lot of different variables of what that might look like when it comes to that monthly PMI. For instance, I was let's see here. I was going through a buyer yesterday. I was pricing out private mortgage insurance for a 3% down loan. It was a $300,000 loan. They had great credit scores. I think it ended up being, it was 3%. It was $78 a month.
That's not bad.
Yeah. So $300,000 home, 3% down, around $78. And utilize PMI as your best friend.
Yeah.
I'll go back into my particular story. I bought my first home 2018. I put 5% down. I refinanced then a few years later. At that point in time, I then had 20% equity in the home. My interest rate dropped as well.
Sure.
My payment dropped significantly. So, PMI, like I said, it allows you to get into the home without putting 20% down at the end of the day.
Perfect.
Which not everybody and not most people have 20% down.
No. A lot of people, especially first-time home buyers, whether it's a gift from parents, grandparents, something like that, most of the time they don't have the 20% to put down. Yep. PMI is a little price to pay to get you out of renting into a home. getting into ownership, building equity versus just paying a landlord to rent an apartment or something like that for the time being.
Yeah, exactly.
But
Exactly. So, like I said, PMI is your friend.
that's it. That's it. Well,
So,
the other question I had for you.
yep.
So I was talking with Maria, and she's on Ben's team here at Exarban Mortgage, and we wanted to go over basically what is the process when working with you. How does that work? Just getting in touch to everything else. My bad.
Yeah, yeah. As far as, depending on how you find out about us, whether that's through social media, whether that's, you get introduced, to us by,
A
Ben,
realtor.
yeah,
Yeah,
a
yeah,
realtor
yeah.
at the end of the day. The processes might, for the most part, pretty similar. First we like to have a discovery call, 15-minute discovery call to just kind of get an idea of what you want to do at a 30,000 foot, view, goals, timeline, and credit, income, and assets. From there, if it makes sense, we think we're, a good fit for you. We'll lead you then to our questionnaire, which is our application.
Mm-hmm.
Takes about 15 minutes as well, depending on how detailed you want to be on that.
And where's that at? Is that online, in person?
Yep, yep. So I mean, we can definitely do it in person. Um,
Bedtime? Is that what that is?
oh, sorry about that.
Ah!
So we can definitely do it in person. Most people will just fill it out online now. Usually after the discovery call,
Sure.
I will just then send it right to them over text, or if they prefer email. So yeah, it takes 15, 20 minutes tops. Fill out. From there, once we get that, it'll take us, depending on timing, 24 to 48 hours to get back with you with at least a pre-qualification letter and your buyer's guide. And with that pre-qualification, we're only going to do a soft pull too initially.
Well, while we're right here, let's pivot off a little bit. You were going into it a little bit, I believe, but what's the difference between that pre-qual and that pre-approval?
Yeah, so a pre-qualification letter, you really, we're just kind of taking the information that you provided us. So, depending on, how accurate you do fill out that application. And of course, everybody might be a little bit off on, what their income, based off, if it's their commissions or, varying hours and things like that. But um, that's like what we go off of essentially is, we see your liabilities through that soft pull,
Mm-hmm.
see what your credit score is. We're going off of your income that you provided us, versus a pre-approval. That is when we get all the documentation needed to then provide you with a pre-approval. And that pre-approval letter, and that pre-approval process is based on us looking over the documentation, making sure your credit, making sure that your income is where you said it is.
Sure.
We got to trust. We trust, but we verify at the end of the day. Make sure you have enough assets in there as well.
So the pre-qualify is kind of just like, hey, this is how much I make. This is kind of my rough debt. How much can I afford? And that's when you'll send out a pre-qualified saying, this is roughly how much you'll be able to make. But that pre-approval is when they actually send in like W-2s, 1099s, everything like that.
Yeah.
You look at their bank stubs and actually confirm that that's what they make and that's their debt.
Yep, exactly.
Perfect.
Yeah. So yeah, we'll ask you for your IDs, your last two pay stubs, your W-2s, your bank statements, tax returns if needed.
Sure.
And then be able to give you a kind of a little bit more of a firm number around everything.
Okay. So say we go ahead, we got the pre-approval, they're verified, everything like that. We find the perfect house for them, and we go under contract.
Yeah.
So we're under contract with them. I already did my side, our inspections, everything like that. I got them handled on that side. Now we're in your ballpark. Yep. What happens next? What process do they go through to actually close on the house?
Yeah. So once, and kind of going back a little bit too, with that live personal buyer's guide, you're going to have a pretty good idea of what that final, cash to close, what that payment's going to look like.
Sure.
Give or take a couple different options in there. But so once you do get under contract, that is when we're going to start really getting things moving. We're going to send out your initial disclosures within 3 business days. And those initial disclosures are so we can order the title, get things going on the appraisal piece. Get the appraisal
Sure.
going. It's an absolute must. And then also get things into underwriting as well. So, and then through that, you know, we keep you updated every Tuesday moving forward. And then just make sure that you are aware through either us, our processors, on what you need at every step of the way to make sure that you get to the closing table.
So that's one of the big things that I like working with Ben. Every Tuesday, he sends me a video update of where my clients are at. I'm personally buying a house with him as well, so I get a video update on Tuesdays of where my house is at. It's just something that constant contact. It lets us know where we're going, where we're at now, and what we already completed, so that way you're not left in the dark.
Yep.
Really appreciate that.
Yeah, absolutely.
Absolutely.
It's something that we've been doing for a long time. So
awesome. So now that we're at the closing table, let's say we're closing here in about an hour.
Yeah.
When we're getting there, what do we need to bring with us? What are we doing there? What's going on?
Yeah. So to the closing table, really you're only going to need two things. You're going to need those funds to close, and then you're going to need your ID.
Sure.
They got to confirm that you are who you say you are. Everything is good on paper. And those funds to close, those can be either brought in through a cashier's check. Those could be a wire from your bank. If you are selling a home and buying another home, that could be a wire from the title company where you close your existing home, and and a wire between both the title companies at
Sure.
the end of the day. So those are the three that I see the most.
Gotcha.
But cashier's check is usually